Hello everyone, welcome again to Fin Advisor. Today we'll be doing a fundamentals of ICICI Lombard General Insurance. We'll start with the insurance industry and why does it look so attractive. Then we'll jump to company specifics. How does ICICI Lombard look as an enterprise? We'll look at the overall financials. We'll also try to do the valuation of the stock, which is generally quite complicated for our insurance industry stock. We'll do it in two ways: price to book and price to earnings. And finally, we'll look at some of the key risks if we want to invest in this stock. So this is going to be a very interesting video if you are looking to invest in insurance industry. So would request you to stay till the end. Now let's look at the insurance industry for India and worldwide. So generally there are two insurance products: life and non-life insurance products. Non-life is essentially your motor insurance, health insurance, crop insurance, fire insurance, so on and so forth. And when we look at the penetration in India, it's roughly about, the total penetration is about 4%, where the life insurance is about 3% and the non-life part is about 1%. And this is comparatively very low when we compare it with the developed countries. Most of these countries have a total penetration of above 10%, be it US, UK, South Korea, UK. And for India to from this level of 4% to reach above 10% penetration, there is a long headway for growth for this insurance industry. Now let's look at some of the industry specific charts for the Indian insurance industry. When we look at the trend of premium underwritten, so it has been growing at a double digit pace over the years, last 5 years specifically. And there are two different types of players in the industry. One is the public players, for example LIC, and then the private players. Even in the general insurance industry, other than the life insurance, we have four types of players: the PSUs, the private sector players, standalone health insurance players, and the specialized players. And roughly the overall market share for the private and the other players has been increasing over the years, while PSU shares have been losing their market shares over the years. When we look at the different segments that are there in the general insurance, the most two important major segments are the motor and the health insurance, and other than that there is fire insurance, marine, and some of the other insurance, for example crop, and so on and so forth. In summary, why should we even consider insurance industry? So like we discussed, there is a variation of non-life insurance products in India, about 0.97% of GDP, compared to the global average of around 2.3%, so which provides a huge potential to grow further in this industry. The industry overall grew at a CAGR of 17% in the last 2 decades, and this is expected to continue further in the coming years. Even the private sector market share has risen from 15% to 49.3% in last 17 years. FDI limit in insurance sector has increased from 49 to 17.4%, which should result in higher investment, foreign investment in this space. Corona pandemic has also changed the landscape, especially for the products such as health insurance. There is an increased amount of awareness for these kind of protection products. Some of the other aspects such as urbanization and demographic aspects such as rising middle class, increasing financial literacy amongst millennials, these are significant drivers for growth of insurance.
Now let's look at the company specific for ICICI Lombard. So it has been a market leader since FY 2004. It is a leading private sector for non-life insurers. The CAGR for last 13 years is close to 12%. Market share after its recent merger with Bharti AXA is close to 8.3%. It has a diverse product portfolio and a multi-channel distribution. Of late, it has been focusing on increasing the distribution network in Tier 3 and Tier 4, where the scope of growth is higher. It has a digital arm specific for technology, so very focused on technology, very prudent risk management team, and also in terms of capital conservation. It has maintained a solvency of 2.45x compared to a minimum requirement of around 1.5x. When we look at the product mix of ICICI Lombard because it has a very diversified product portfolio covering motor, health, travel, personal accident, fire, marine, crop, and others. Uh, the majority part of the product portfolio, about 44%, is in the motor, in 22 in the third party, and 22% in the own damage. While the next top segment is the health, travel, and personal accident, while fire constitutes about 17%. ICICI Lombard has focused a lot on the digitization initiatives. That is the main reason why it has now the lowest expense ratio in the industry due to continuous digitization. When we look at some of the specific initiatives that it has taken in policy issuance, about 97.2% policies have been issued electronically. In claims and servicing, about 80% of the motor OD claims were done through Insta Aspect. Even in the headcount productivity, there is a 15% CAGR from FY 2008 to 2021. It has also done a cloud deployment and a big data and customer experience management. In even in AI and ML solutions, 66.4% are done through cashless authorization through AI, while 85.3% of STP motor break-in was done through self-inspection. Mm. So, and it has also has a dynamic workforce with remote working policy. So overall, it has done a lot in terms of digitization, and it continues further to improve efficiency to reduce the. Even in risk management, ICICI Lombard has done quite well. In underwriting, it has an initiative, be it predictive loss model, diversified exposure across geographies, and also has a lower proportion of losses during catastrophic events. It has also spread the risk across panel of quality reinsurance, which reduces the overall risk. Even in terms of reporting, it has been disclosing the reserving triangles, which talks a lot about corporate governance and transparency it is bringing in. In investments, it has about 90% of the portfolio in debt, which is on AAA rated securities. It has a almost zero instance of default since its inception, which is quite exceptional in this kind of scenario. When we look at the financials for ICICI Lombard, one of the key ratios that is looked in the insurance sector is the combined ratio. Ratio which is less than 100% signifies that the claims incurred and the expenses the company was able to manage within the premiums that were received for the insurance. So ideally, it should be less than 100%, but due to Corona pandemic, the combined ratio has shooten up about 120 to 125%. It is for the industry, and while for ICICI Lombard, it is about 111%. This has taken a hit on both the profit before tax and the profit after tax, going down for this year. But as the pandemic settles, this the profit and other metrics should again uh, come to normal. The return on equity has been on the higher side, more than 15%, and in some cases more than 20%. This should again go up as the impact due to pandemics comes down. When we look at the investment book, the return that the investment book has been able to get is about 6 odd percent. About 90% of the portfolio is in the corporate bonds and the government security. The investment book roughly is growing about 20% on an average over the years, which is a really good growth rate for this size of company. Now let's look at the valuation for ICICI Lombard. Generally, valuations paid for insurance stock. Different people have different opinion on how should a company be valued in insurance sector. So I've made two attempts in using price to book and price to earning. Let's first look at price to book. So when we look at the historical graph and the current valuation in terms of price to book, historically the median price to book that ICICI Lombard has been able to get is somewhere close to 8.5. Now, given that there are higher claims ratio and the higher claims that has been incurred due to corona pandemic, the profitability has come down for short term, and now the price to book has come somewhere around 6.5. So based on the median valuation, it definitely looks undervalued at this point of time. Now let's deep dive further and try to estimate the bull base and bear case scenarios using book value. So currently we are sitting at the levels of 1245. Historical book value growth rate that we've seen over years is roughly about 20%. And let's assume in bull case, the book value will grow at 22%. In base case, the book value will grow at 17, and bear case, it will grow at 15%. So these are the values assuming these growth percentages. In FY25, in bull case, let's assume that the price to book multiple ICICI Lombard will be able to get would be around 12, base case would be 10, and bear case would be 7. Based on this, if we multiply these figures with these, we'll be able to get the FY25 stock price, which will range between 2000 to 4150 from bear case to base bull case, which results about stock price X of about 1.6 to 3.3 times, and a stock price CAGR of 21% to 78%. And please bear in mind, this is definitely not a recommendation. This video has been made from an educational point of view. Now let's try to estimate the valuation for ICICI Lombard using price to earnings. Try to estimate the earnings till FY25. And there are two types of earnings, operating and non-operating. Operating is from all the products, insurance products that ICICI Lombard has. So premium earned has been assumed to grow at about 15%. Investment income is again from the policyholders fund. This has been again assumed to grow at about 15 to 20%, and it will be able to get an yield of about 6%. The main assumption in terms of underwriting profit loss is that it will normalize. Currently, it is quite high due to COVID pandemic, and this will normalize to about 104% of combined ratio, and this will result in a nominal 5% underwriting loss on the premium earned. And the investment income will continue to grow both from the policyholders and from the shareholders. So this will result in PAT to grow significantly till FY25, and the EPS will grow to about 69 from till FY25. And if we assume three different scenarios for what could be the price to earning multiple that ICICI Lombard will be able to get in FY25, let's assume 60 for bull case, 50 for base, and 40 for bear. That means if we multiply this EPS of 69 with these P multiples, the price could range between 2,700 to 4,100 between all these cases. Now let's look at some of the key risks for ICICI Lombard if we were in this stock. First key risk is with respect to COVID-19. This has resulted in high loss ratios. If we see a new variant, which seems a bit unlikely at this moment, but if we see a new variant, we still may have lesser profitability for the short term. ICICI Lombard also has very high dependence on auto sector. About 44% of the product portfolio is comprised of the motor, and this industry is facing a lot of competition in terms of premiums, and also there are industry headwinds with respect to chip shortage, which has resulted in lesser new private car sales. There are also talks about de-tariffication of the third-party product, which is about 22% of the ICICI Lombard portfolio, and this can result in price war and industry pressure and reduced profitability for ICICI Lombard. ICICI Lombard has also a lagging healthcare portfolio, given that it was one of the first entrants. We would have hoped that it would become a market leader, but there are other players who have taken significant amount of market share in the healthcare portfolio where ICICI Lombard needs you to. That's all I wanted to cover in ICICI Lombard fundamental analysis. Hope it was useful to you. And if you like this video, please do subscribe to the channel and share with your family and friends. Hope to see you in my next video.